Predictions for 2026 are out, and the word is, shockingly, it's going to be a huge year for the stock market. And guess what? It very well could be. You're hearing things like life-changing gains, AI-driven booms, and rate cuts from the Fed. Sounds exciting, right? But here's the truth most people won't tell you. Yeah, the stock market could change your life in 2026. But which direction it goes, that's still wide open. It's a crapshoot. I was reading through some reports, and they're all over the place. Some analysts are more bullish, calling for major upside driven by earnings growth, big gains from artificial intelligence, etc. Others are waving a red flag, saying stocks are overpriced, inflation might pick back up, and we could be staring down the barrel of a correction. And here's the kicker. They're all using data to make their case. One side over here says, hey, earnings in the S&P are set to skyrocket. If those profits come in strong, stocks will take off. The other side, hold on. Valuations are already sky high. We're pricing in perfection. That's dangerous. You've also got the potential for Fed to cut interest rates. And if Jerome Powell does start easing in 2026 before he leaves, that could support higher stock prices. But remember, Powell very recently himself just warned that equity valuations looked very stretched. Now, artificial intelligence? Absolutely driving productivity, changing industries, opening up new opportunities. But bubbles have formed around tech before for the exact same stories, driving productivity, changing industries, opening new opportunities. The story has not changed, just the characters. Just because it's new doesn't mean it's going to be different. So here's what I want you to understand. The market will move in 2026. There's no question. The question is, how are you going to navigate it no matter which way it goes? Because this next year could absolutely be life-changing, but it can go either way. So let's dive into what's really going on and what you should be doing right now to stay disciplined, protect your downside, and position yourself to build real wealth in the long run, no matter what happens next. Now, let's talk about what 2026 could look like for the stock market. I just read this article from Yahoo Finance, and there's a lot packed into it. First off, they point out that the market is showing a pattern we only see every 5 years or so. And historically, when this setup hits, we tend to see big moves in the market. It doesn't mean we know the direction up or down, but it means volatility is coming. And for patient investors, volatility is a huge gift. But here's the story. Jerome Powell and the Fed could play a major role. The article highlights how investors expect Powell and the Fed to cut interest rates further in 2026. And when rates come down, borrowing gets cheaper. Businesses can spend more money growing, they can grow easier, and stocks often get a tailwind. But here's the catch, and this is where most people get it wrong. Just because Powell might cut rates doesn't mean every stock becomes a great buy. The article also brings up artificial intelligence, sector shifts, global economic trends, and yeah, all of that could shape the next big run. Powell also said, and this is really, really important, he came out and said, yeah, stock prices are looking pretty stretched. Now look, the Fed doesn't officially say what stocks should be worth, and they should not say that. They're not in the business of setting price targets. But when the head of the central bank starts throwing out comments like that, especially when it could hurt his reputation, you might want to pay a little bit of attention. Right now, the S&P 500 is trading almost 23 times forward earnings. To put that in perspective, the 10-year average is about 18.5. And that 10 years is in a big bull market. So we are way above normal even during a major bull market. And historically, we've only seen the market this expensive twice. Once during the dot-com bubble and again during the COVID madness in 2020. And in both cases, the same thing happened. The market eventually turned into a bear market. That 2000 bear market was a 3-year long, just pulling through the sand, just a tough bear market. That's the point where people believed you couldn't make money in the market. Now, COVID was a very scary event, but boop, it was over and done. We moved on from it. Yes, we had a bear market in 2022, but again, that was a very quick one with an immediate bounce back. So could this all happen again? Of course it could. Just because stocks have been going up doesn't mean they're going to keep going up, especially when they're already priced in for perfection. Now, guys, another thing to remember is how much of the stock market being up is driven by the major companies, a few major companies. A big chunk of the gains in the last few years have been driven by a small group of stocks. So what do we do on this channel when we see things like this? We stay focused on the same principles we've always followed. Looking at free cash flow, looking at solid balance sheets, having an ample margin of safety where price is below value. That's how you prepare for any bull or bear market and whether Jerome Powell cuts rates or not. I want you to think the same way that Warren Buffett thinks. He always said, if I had the Fed chair in my ear telling me what he's going to do with interest rates next year, I wouldn't change anything of what I do. And 20 years ago, I couldn't understand that. Now I understand that fully. And I want you to get to that point. Now, this next article from NASDAQ.com shares how there's a lot of noise flying around right now about where the stock market could be headed in 2026. And if you've seen the numbers coming out of this article, you know that there are some insane forecasts out there. Medium forecast, that's the only one that averages out all of Wall Street opinion, says the S&P could hit 7560 within the next 12 months. That's a little under 10% upside from where it's trading today. Guys, I want to give you guys a little hint. You go back decades. You ask the analysts where the market will be a year from now. You know what they end up saying? The average ends up being around 9 or 10% higher. Why? Because it's historically what we've done. So everybody just gravitates to that, no matter where they're starting from. But then you have Evercore's bull case. And when I say bull, I mean bullish case. They're saying the S&P could hit 9,000 by 2026. That's nearly 30% upside. And guys, there's a but. And the big but here is Morgan Stanley actually comes in with a bear case. They're saying the S&P could fall all the way to 4,900 by 2026. That's 30% downside from today. Why? Very simple. The economy slips into recession. If earnings disappoint, the market could absolutely take a hit. Here's the point, guys. This isn't about who's right or wrong. Either one of these cases could happen. We have no idea. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. The short run is a year. Whenever it says to me like, oh, well, long run is over a year, they're using the IRS definition of long-term capital gains. No. The short run stocks are a voting machine. What's popular will go up. What's not popular will go down. Could we see another 30% gain? Absolutely. Could we see a 30% drop? Absolutely. And let's not forget, the S&P is already up 17% this year, even after getting rocked by that tariff announcement from President Trump back in April. That's shaping up to be 3 straight years of double-digit returns. Now, if you're watching this video and you're looking at me saying, so wait, it could be up or down, this doesn't do anything for me? Good. I want you to hear that and realize that nobody has a fucking clue where the market will go. You got to stop listening to pundits. Sometimes I go to our YouTube comments and I see people say, hey, Paul, where do you think the S? I don't know, guys. I will never, ever say where I think a stock will go. What I will say is, this is what I think a stock is worth based on a 10-year analysis. If I can buy it for less today, I'm happy. I will let the next 10 years take its course unless my thesis changes. So the question a lot of people want to know today is, does the momentum carry into 2026? Now, let me ask you one quick question before we go further, because I think it's important to understand this. Let's say the market's at 6,800 right now. Let's say that you knew the market was going to 8,000 next year, but then 3 years from now is going to 3,000. What does it matter if it goes to 8,000? Who the hell cares? If it plummets all the way down to 3,000 and you're always going to hold, then it doesn't matter that it goes to 8,000. That's the way I want you thinking. What's it worth? Is it worth 3,000? Is it worth 4,000? Is it worth 10,000? These are the questions we have to ask. Same with any stock. It doesn't matter where it's going right now. What matters is, what is it worth? We're not in the business of guessing where the S&P is headed. And if you want to follow people that'll do that, there are plenty of people out there that'll do that and will be wrong 98% of the time. I don't care if the target's 9,000 or the downside risk is 4,000. That's all just noise. No one can accurately predict the market over long periods of time on a year-to-year basis. Our job, the job of a real disciplined investor, is to focus on what we can control, analyzing cash flow, analyzing balance sheets, and coming up with a valuation process that works. That's it. We buy great companies at great prices, and we keep buying them as they're undervalued. Because here's the truth. 2026 could be your year, but only if you're ready for both outcomes. That means learning to not chase hype. That means not panicking during drawdowns. That means not panicking during deep bear markets for whatever the story is out there. Remember, guys, every past crash ends up being an opportunity. I want you to look at it that way for future crashes. You need to have a strategy built on principles, not predictions. This is exactly why I teach on YouTube, guys. because I look at it and I realize over the years what really drives value. And there's a lot of great people out there watching this video who didn't have the opportunity 20 years ago to be able to understand that. I didn't either. I didn't have the masses in these videos to say, hey, this is valuation. I had to sit there and go about it my own blindly. I wanted to be the person who was guiding people along the way. And it doesn't mean you're going to agree with me on everything I say, but I want you to agree on the process in which we think, that it's possible to buy something undervalued. If you believe that, then you can do very well. Now remember, I make these videos because we are on YouTube. The title will say one of a million things, but I want you to remember, the title is not what matters. What matters is what we're trying to teach in the videos here. So guys, let's take a quick step back and really understand something that almost no one on Wall Street talks about. What actually drives the market higher? It's not headlines, it's not emotions, and it's definitely not predictions. In the long run, the stock market only goes higher for one reason. The companies within the stock market make more money. That's it. Stock prices follow profits. If a business grows earnings and generates strong free cash flow, their value increases and the market goes up. That's the real engine behind long-term wealth. As an example, let's say you own a business and it makes $100,000 a year. What's that business worth? 300, 400, whatever the number is, determine that number. Let's say you knew 5 years from now it was going to make $1 million a year. Is it worth the same amount of money or is it worth 10 times more? Probably 10 times more because it made 100,000 before. Now it makes $1 million. It's probably worth 10 times more. The key here is that along the way in the stock market, you've got to be able to put up with the massive gyrations and volatility in stock price. And to go back to it, here's where people get confused. Ben Graham says, in the short run, the market's a voting machine. In the long run, it's a weighing machine. I love that quote. And it's actually our fourth tenet of principle-driven investing that myself and everyone in the Everything Money community invest thinking about. It means that whatever's popular in the short run is going to go up. Whatever's not popular is going to go down. People vote with their money based on hype, fear, and headlines. TikTok trends, whatever's loudest that day. That's why prices go up and down massively. Guys, I always show this as an example. Look at NVIDIA, one of the most popular, profitable, and most expensive company in the market right now. In the last 1 year, its price has changed from a low of 86 to a high of 212. Please don't tell me that's a rational number. Please don't tell me at 86, when it was falling at 86, that it was a bad company and that it's a better company at 212 all within 1 year. That's not possible. But in the long run, the fundamentals will weigh in. It weighs earnings, it weighs cash flow, it weighs fundamentals, and eventually the truth catches up every single time. The best example I have of this is Cisco. Cisco was one of the NVIDIAs of 2000. It was going to be the first trillion-dollar company. Let's look at it this way. This is the 10-year chart on Cisco. Looks pretty awesome, doesn't it? It's up 160%, not including dividends. Here's the max chart. Guys, the peak was hit at $82 back in 2000. It has not been there since. But the ironic part is, here to here, the stock is up 10x. Guess what the profit is up? Also 10x. But it didn't go this way. The stock here is only up 3 or 4 times in terms of numbers. Why? Because in the short run, stocks are a voting machine. In the long run, they are a weighing machine. This is the best example I have. And guys, guess what? This isn't the only example of this. This is the only example of this kind of, I love this story because Cisco was literally the NVIDIA of 2000. Go Google it. Literally, you were dumb if you didn't have Cisco in your portfolio. It was going to be the first trillion-dollar company. You got to get on it. Now, what does that mean for today? Well, guys, based on today's valuations, I've said this many times before, I believe that we're going to have a sideways market over the next several years, 5, 10, 15 years. What does that mean? Well, it means we could see a lot of volatility, a lot of up and down, but very little overall return from the broader market. Why? Because stocks are priced today for perfection, maybe even above perfection. We have pulled forward a lot of future returns and saying, okay, let's keep extrapolating on this. Guys, unless earnings growth is significant and quick, there's not a lot of room for prices to keep running. But the good news is that that's not bad news for disciplined investors like you. That's a gift. Because in a sideways market, emotional investors get tired. They bail. Oh, this isn't working anymore. Let me go chase the next shiny object. Meanwhile, the patient investor, the investor I want you to become, The one that focuses on price versus value gets to slowly build wealth by buying great businesses at prices that are awesome while everyone else gets bored or scared. So, let the market move sideways. Let it be a weighing machine in the long run. We're not here to vote for what's popular. We're here to see what the market says is the price and what we determine the value at. We're here to weigh what's valuable, price versus value. That's how you will build real wealth. That's how you win. And more importantly, that's how you stay calm during the tough times. So, we've talked about how 2026 can go in either direction, a big move up or a sharp drop down. And I've said it before, we don't know which one it'll be. No one does. But here's the good news. You don't have to know. You don't need to predict the future. You just need a process and a game plan that works in any market, up, down, sideways. One that builds your confidence and keeps you focused when everyone else is panicking. So let's talk about what you can actually do right now, because this isn't about fear. This is about preparation. This is how we make sure we are ready no matter what happens in 2026. First off, dollar cost average and a low cost ETFs. One of the simplest and most powerful strategies I know is this. Guys, I do it every month. I invest in my low cost ETFs every single month. If I do it consistently, no matter what happens in the market, I will continue to match the market returns. I'm going to buy when stocks are up and I'm going to buy when they're down. And over the long haul, I'm going to pay this price for it. That's what's key. When you buy an ETF, you're buying a basket of companies. You get exposure into hundreds of businesses in one move. The ETFs that I buy the most of are SPY, VOO, SCHD, and when the price makes sense, I will do QQQ. They're low cost, they're diversified, and they work in the long run. But here's the key. You don't have to time it perfectly. That's what makes it so brilliant. You invest regularly, and when everyone else is freaking out and selling, you have the option then of leaning in a bit further. But until that day comes, when the screens are red and people are panicking, you won't feel like buying more. But I want you to remember this moment completely. That's when opportunity shows up. Now, here's another strategy. Maybe you're thinking that the S&P 500 is, not looking good and you want more upside. Or maybe you're looking at how top heavy the market's become. That's an absolutely legitimate concern. Big tech has had a massive run, has driven this market. Are they great companies? Without a doubt. They are basically priced like nothing can go wrong. And that's when things get dangerous. Just like when stocks get so cheap, they're priced like nothing can go right. That's when you find immense value. So here's how you can position yourself smarter. First off, never stop dollar costing into low cost ETFs. Make sure you're hitting all your retirement goals with that. But if you have extra money, you can tilt your portfolio towards areas that may be undervalued. For example, smaller cap stocks like those in the Russell 2000, they tend to do very well after a downturn in the major market. Commodities like gold and silver, they shine when cycles shift. We've seen a big surge lately in gold, something that we've talked about in the past. I've owned GDX and GDXJ. Those are gold miners for several years now, back when gold was $1,500 or $1,600 an ounce. Now, I know gold has surged, and we don't know where it's going from here. But energy, commodities, industrials, international stocks, these things can do very well as people leave big tech when there's a bear market and go into other areas for value. Now, guys, to be clear, these are not risk-free areas. They can still fall in a bear market and they can still fall hard. But they've got more room to run on the other side because they're starting from lower valuations. That's how you play offense without chasing hype. Now, third strategy. And if you're picking individual stocks, this is where you can really separate yourself from the crowd because let's be honest, when the market drops, hype gets destroyed. The castles in the sky, perfection, everything going great companies will suffer. These are probably a lot of the Mag 7 companies. They're still great businesses, but they're going to drop hard too. They will survive. And when they do survive, they will thrive again as a stock investment. But you've got to get to the point where the price is well below value before you can see major upside. So here's the core lesson. The most important thing in investing is knowing the difference between price and value. Price is what you pay, value is what you get. When prices crash, that doesn't mean value is crashing along with it. In fact, that's often when value finally becomes visible to the people who are ready. And I want that to be you. So whether you're investing in ETFs, if you're shifting sectors or picking stocks, your edge is the same. Clarity, patience, and discipline. You don't need to predict the market. You don't need to follow the crowd. You just need to understand what you're buying and why you are buying it. And if you can do that, 2026 won't just be a year that changes lives. It'll be the year you started building your financial life. Guys, I know exactly how it feels to be paralyzed by fear in the stock market. You're probably thinking, I know I should invest, but what if I buy the wrong stock? What if I lose everything? I had those exact same fears 25 years ago. I made massive mistakes. I followed hype, I followed tips, and I lost money. But critically, every mistake taught me a valuable lesson about investing. And that's exactly why I decided to build Everything Money, to take that knowledge and turn it into the tools I needed to make better investing decisions. Now, I want to share that knowledge and those tools with you and build the community that I wish I had back then. So join our community and you'll learn how to see a company's value, how to make smart choices, and most importantly, how to sleep at night knowing that you aren't gambling anymore. You're now an investor. So start your 7-day trial today. Let's take the fear out of investing together. As I've said many times in this video, we have no idea where the markets are going to go in 2026. Could it go up? Absolutely. Could it drop massively? Absolutely. There are people making great arguments for both. But here's the problem. Most investors hear that and immediately think they need to do something. Buy more when it's going up, sell it all when it's going down, and go to cash. And that's exactly why they fail. So let's talk about the mindset and the emotions for just a few moments. So once you've done the work, you've studied the company, you understand the business, you have figured out its value, the next step isn't action. It's usually patience. That's the real game. And let me tell you something very clearly. That is the hardest part. That is why most people fail. Everyone loves the rush of buying a stock. Guys, I love it. Everyone loves it. Everyone loves bragging when they sell for a gain. But the big money, that shows up when you sit still, you sit on your hands, and you let time do the compounding. That's part of your job as an investor, waiting. And while you wait, that business, if it's a good one, is quietly churning out cash flow. It is reinvesting that cash flow. It is increasing that cash flow, and therefore it is growing in value. The problem is most people can't sit still. They see a stock drop 10% and they feel like they have to react. That itch to act, that emotion is what is going to kill returns. And this is what separates real investors from speculators, the ability to sit on your hands. Look at the people in history who've built massive wealth. They weren't flipping in and out every few months for the most part. They bought a great business at a great price and let time do the heavy lifting. Look at the people that you know who are wealthy who started their own company. Do you think they bought and sold their company every year when prices were high or prices were low? No, of course not. They sat there and built their business through the ups and the downs of the market. But the truth is, buying right will set you up. But waiting is what unlocks the reward. And that's why principle-driven investing matters so much, especially when the market is unpredictable. Principles will keep me grounded. They protect me from these emotional decisions and potential huge losses, not just from seeing a stock fall, but selling too quickly, which I've done in the past a few times. When prices swing wildly, and they always do, emotion tells you to panic when it's down and chase when it's up. But principles remind me of what actually matters, the difference between price and value. When I stick to my process, I don't care if the stock drops tomorrow. I don't care if the stock drops in a week, a month, whatever it is. If my value hasn't changed, my decision does not change. That discipline gives me confidence while everyone else is freaking out. Now listen, principles won't make you emotionless. That's impossible. You're still going to feel the fear, the FOMO, the doubt. Embrace that. That's normal. But principles give you a framework so that when you do recognize that fear, that FOMO, and that doubt, you're able to say, I've been here before, I've seen this before. So now your decisions will come from more logic and less emotion. So let me give you these 5 principles I live by. And these are the exact same ones I use and the entire Everything Money community follows. First off, we are investors, not speculators. Second, every investment is going to be determined by the present value of all the future cash flow that it generates. Third, if we don't understand it, we don't invest in it. Fourth, in the short run, stock market is a voting machine. In the long run, it's a weighing machine. And the fifth and probably most important one, and the one that everyone misses, A great story can become a terrible investment if you pay the wrong price. These principles are why I'm able to stay calm when markets are loud. They're exactly why I don't get caught up in predictions or panic during downturns. Now, I don't expect you to memorize all of these right away. This is exactly why I put together a simple, free PDF that lays all 5 principles out for you. No fluff, no Wall Street jargon, just the rules and how you can apply them and what they mean. And I use these to avoid big mistakes. But guess what? I don't just look at them once. I look at them all the time. It's all about getting it embedded into your brain. So this is your cheat sheet. When prices are flying all over the place, which they will, when people are yelling about recessions or rallies and missing out, you pull it out, you read through it, you remind yourself why you're here, to focus on price versus value, not the daily drama. To remember the times in the past when a company went flying high and then fell, even though the fundamentals got better, because guess what? It happens way more than you think. Here's a prime example. This is Apple, guys. I'm going to go look at Apple from right here. Almost exactly 4 years ago. The stock hit a high of 176. It's currently at 268. So that's a gain of $90 on 170. It's a 50% increase in the last 4 years. Okay, pretty solid for the stock. Let's go look at the fundamentals and let's see what that means. In 2021, $365 billion in revenue. The last 12 months, $416. It's a gain of $50 billion. That's about 13.5% growth of revenue versus the stock up 50%. Okay, what about profit? The profit was $95 billion, now to $112 billion. That's $17 billion on 95, call it 18 or 19%. So guys, the stock is up 50%. The fundamentals are up 18 or 19%. Is the stock currently overpriced? Was it massively underpriced before? I just want to show you that these things don't work in tandem. And the great thing about principle-driven investing is it allows you to sit there and say, okay, what is going on here? Instead of just worrying about the price going up and down. So if you want to understand and get the cheat sheet for principle-driven investing, click the link in the description below and download it now. Keep it handy. This guide could be the difference between building wealth and blowing up your portfolio. And if you're ready to go even deeper, we've got a full course that walks you through exactly how to value a company step by step. Because the truth is, prices will always move. That's just the market being the market. But value doesn't fluctuate as much. Value is more steady. And when you understand how to calculate it, you stop getting pushed around by the noise. I believe that there's a time coming when stocks are going to be much cheaper. That's why I need to build this skill set now. So in this next video, I'm going to walk you through how we actually value a stock, what to look for, how we think about risk, and how to avoid overpaying for hype. The link is right here on your screen. Click it, and I will see you there. Thank you for your time.